And I have a wonderful guest, someone we met with at a Genius Network conference last year, and we clicked as soon as I said the words "clarity is actually leverage." Emily Stubbs, Director of Legal Solutions for Visibility CFO and Tax Advisors. Welcome. Thanks for coming.
Thanks for having me.
So, do you remember that clarity is leverage conversation?
I do. I do. And it's one that we have often. So yeah, but it is what we do at Visibility.
It's a lot of fun for me because when I think of what you do and what I do, we deal with people who enter that room, those big decisions, those business owners once, and you walk in to deals, deal structure, capital decisions, contract negotiations all the time. You live there, right?
Yeah.
And I would make the argument that's where enterprise value is actually created, but it's often forgotten or delayed.
Yeah.
What do you see come up? What do you see the roadblocks that hit owners that they just basically like, oh, I'll wait for it later?
Yeah. That is the human response, right? We'll deal with it when it becomes a fire. But at Visibility, we're really trying to get away from that and help it make it easy. Do the boring things that everyone tries to avoid, but that give that critical visibility into what your business is actually doing, so that you can make smarter decisions and really have the traction that you need to reach your goals.
So if we were to kind of walk into that first time where you get brought into the room and your team gets brought in, what do you see as a common trigger that they finally click and say, okay, I got to take this seriously. Let's do something about this.
Yeah. I mean, there are multiple entry points. I would say one that we're really focusing on and where we find it is especially critical is, as kind of you were mentioning, that visibility in transactions. So unfortunately, a lot of times it's clients that are coming after they've had a failed transaction or something didn't go the way that they wanted to, feel like they left money on the table, and then they wake up and go, oh, maybe there's something more, maybe there's a different way to do this. But really helping business owners, especially ones that are ready to sell, to demystify that black box of what their business is doing, for investors and buyers, so deals don't stall, retrade, fall apart, and so sellers aren't leaving value on the table.
Do you see deals falling apart and these retrades and just not getting done because of a lack of preparation or because of that lack of clarity? What do you think was going on?
Yeah, I mean, I guess yes to both. If you're not prepared in the clarity, um, but if you buyers don't want to buy a risk, they want to know what they're buying, and this is, I mean, everyone can relate to this, right? When you go buy a product, you're looking at whatever it is you need, a sauna or cold plunge or whatever product you're trying to buy. You're trying to research everything you can to understand what you're going to be buying. And so what happens in the, the low to middle market space is that a lot of times sellers just aren't prepared with the information that, a lot of buyers are looking for. PE is big, and there's lots going on in the market, and institutional buyers and strategic buyers. But it's really important that, sellers are coming up to speed and matching, that need there.
I love you use the word black box, and it has me thinking about a couple items related to the tax changes. But more interesting, you said buyers don't want to buy risk, and you added in our friends in the private equity space. I hear from my clients all the time. They're just getting phone calls. It's the old school boiler room of some fund or a group of buyers that just they're like, hey, are you ready to sell? Ready to sell? Ready to sell?
Yeah.
Actually leads me to the question, speaking about private equity, what does private equity actually look for when they're looking at buying a business? And they're obviously not looking to buy risk, to use your words.
Yeah. Yeah. I mean, it it can get, very industry specific on what they're looking for in a specific industry. But in general, they're looking for reliable, accrual-based financial reporting, predictable cash flow that's not tied to the owner. So there's a team in place, documented processes, and clean legal structures. if I had to kind of boil it down to just just a few things.
No, that's very important. And so these, the folks who get these phone calls all the time, I imagine that it's like, all right, well, this phone's just ringing. I've got ready buyers on the other end. I don't need to do all the other stuff because I would just have to say, yeah, I'm ready tomorrow. And so,
Yeah.
what are some surprises founders actually discover when they actually take that phone call and take that meeting and get into it?
I mean, we see this all the time. So you get the seller thinks the hard part's done. I have a buyer, but there is so much that happens between the time that that buyer calls. And another thing that I think surprises sellers is they come with a number that just makes them where they weren't thinking about selling and now they are because this number is attractive. And but what they don't know is the process that goes. And if you haven't been de-risked, if you have issues with, a legal issue that comes up, you have contractors that really should be employees, or you have these things that are lawsuits waiting to happen, the sophisticated buyers know what they're looking for and they're going to devalue. They can say, oh, we're going to buy it at a 5 times multiple. They get in and they go, actually, not a 5 times multiple. Or they say, you say your EBITDA is this. And then they go in and look at the financials and they start going, yeah, but what about this? What about this? And then all of a sudden your, $20 million offer is a lot smaller. And depending on where you're at in that due diligence process and how much time you've spent and what your timeline is for sale, you might, as a seller, be in a position that you didn't realize you were going to be in because you got all these offers that sounded great from the beginning, but there's a lot that happens in between.
So it sounds like the huge gap is these phone calls and then offers that are coming in are like a dating app. You're swiping left and right, but you're thinking that all you have to do is swipe in that direction, and it's an instantly happy marriage. But there's a
Yes. Yeah.
lot that goes on in the middle, right?
That is a great relatable analogy for sure.
No, that one actually kind of hit me as you were going through that black box. So if someone isn't selling for 5 years, but they're aware of the process, the dating process, if you will. How early should they start preparing, and who are people they should involve along the way?
I would say that it's never too early to start preparing. If you think about if you've ever owned a home and decided that you were going to sell it, all of those projects that you put off for many years, you all of a sudden start doing them. And then all of a sudden your house is way better. And you're like, wait a second, did I really need to sell this? And we see that happen. So either you're going to really maximize your value at sale, or you're going to be running a business that you truly love and is doing the things that you should have done for years. When you're using time as a tool, it actually speeds up your ability to get things done. And so if you're thinking, oh, I need to do this for the buyer, you actually probably need to be doing it for yourself and for your business itself. So it's actually a really great way to increase your value and make your business run better today so that when it is time, you're ready and it's not you're de-risking for yourself and for your buyer. And then the second part to that was the team that you would need. And so, there's always a lot of great advisors out there. For sure, you need a CFO level financial advisor. A lot of companies, they'll have a bookkeeper, they'll have an internal accounting team. But if you're not looking at those numbers with a level of strategy and a level of insight, as well as a sophistication that's getting you ready, whether for sale or for investment, capital, bank loans, whatever it may be, that CFO level is going to be super important. Tax strategy, especially when you're getting ready for sale, because capital gains can have a huge effect on the bottom line. So thinking of the right structures today ahead of time is super important. And there's actually some strategies you can't use once you've already decided and are already under contract to sell, to help avoid some of that capital gains. And then that transaction experience, legal counsel, the devil is in the details, and making sure you're thinking of the deal structuring in a way that you're protected is important, as well as kind of those broader legal risks that we talked about. There's also other advisors out there, like EOS implementers and people that can help operationally, that get those processes in place and help you to um, step away from your business, so that those other things that PE firms are looking for, the seller not being critical to the operation of the business, as well as those two things will help the buyers see that. So
You make me think of Rogue Wealth rule number 6, and I call that one: if you don't understand the paper owns you. And that was your comment about the legal aspect of it.
yeah.
And I'm not saying to be the attorney, not at all,
Mhm.
but understand what the fine print says, because it's extremely important there. And you might be signing up for something that you never intended for.
Yeah. It's yeah. Unfortunately, see it all the time.
Right. Right. No, it happens. It definitely happens. I think there's this delicate balance of delegating but not knowing what you're delegating. And when it comes into the pros, a lot of the folks out there that are one lane thinkers, here you go. All right, sign the box, boom. And then I think that's where that post deal regret happens, when you look back and say, I didn't sign up for that. Yeah, you did.
Yeah. It was
It
all
was
right
all
there in
right
the
there.
70 pages. Yeah.
It was all right there. You speaking about taxes, a big tax bill was passed into law, and I think there's a lot of noise in politics and distractions around it's permanent, it's not permanent. I think some big takeaways from there are there's aspects of it for our business owner clients that have become permanent and extremely valuable,
Yeah.
right? And then
Yes.
and there's other items that have just been they address other issues. But would you say that there's some key important aspects of the bill that we really need to highlight and focus on and run with?
Yeah. Yeah, I mean, as you mentioned, bonus depreciation has been something. There's been sunsets, there's been 80%, there's been this, there's been that. And so really understanding the what depreciation matters for your business, because one of our biggest rules of thumb at Visibility is to not let taxes be the tail that wags the dog. So we're not out there chasing, oh well, there's this big new beautiful bill, let's apply everything that it says. But if real estate is an important part of your business, or it would be helpful, you rent, or you're ready to kind of get into the space of having a building, or it's an important part of taking your business to the next level. There are some super great opportunities with depreciation that is now permanent, and 100%. It's really important though that you're involving a cost segregation engineer, because not all asset classes are treated the same, and even within real estate, you need to be able to divide it up for what is personal versus real property, and those experts help us to make that correctly. But then there's also asset classes like um, gas stations and car washes that are treated differently, and so you get to actually depreciate more of them. The value is more depreciable, and so it's really exciting to look at what options are out there, but with the caveat that you're not doing it just for the tax reasons. You're doing it because it makes sense for your business. And then, I think the biggest thing with this is that to be aware of is that you can actually take a greater when you can depreciate more upfront. It doesn't matter that you're getting a loan. So if you bought an asset that's $1 million, but you only put 200,000 in this piece of real estate, then you can actually depreciate. What is depreciable? Let's say 800,000 of that is depreciable. You can take that even though you're only putting 200 in, because the loan matters. So it's a great an attractive way to get a bigger tax savings today than what's actually coming out of your pocket. So it can be a very powerful tool.
It reminds me of my one buddy who just gets car buying fatigue at the end of the year. You made a comment, don't let the tax savings wag your capital decisions. You said it more
Yes.
eloquently than that. But I tell him every time, I'm like, you got to ditch the strip mall tax person doing cost segregations, figuring out the proper use and deployment of capital is extremely important. That's what the tax code's for.
Yeah.
And he says, well, like, I love the guy. We go out golfing, we have fun. And he says that it's not worth it. And the issue, I think the point is, and we see it in all of our kind of lanes, is that it's too much work for those generalists, and they won't stop and take the time.
Yeah.
And
No.
that's where I think a lot of opportunities are missed.
100%. And the model's not set up for it. When you are doing taxes, there's a deadline and you can only do so many taxes, and you can and when you're getting all those taxes done by the deadline, you don't have time for planning, and then you're so burnt out that it's hard to plan the rest of the year. And so that's where we at Visibility have really paired the CFO and tax, because we're in the business decisions. Those are leading what you should be doing, but there's a tax consequence to each of those business decisions that you want to be thinking about. And whether you have advisors that are working together or Visibility, we have the team here, but having that, your advisors at all of your junctures is super important.
Yeah, it's definitely, it sounds like deploying capital with intention rather than that tax savings is a lot more
Yeah,
valuable, right?
yeah,
And now that leads me to another question, because this comes up, and you've probably seen this, and the idea of taking equity in lieu of payment, right? So it might be a professional advisor that comes in, it might be a consultant. You mentioned some strategic advisors that come in along the way,
yeah,
and we'll see it also in businesses and startups and founders or spinoffs where it's like, hey, don't pay me a fee, give me some skin in the game. Um, and so this is very
yeah.
complicated. But where would you say that someone should consider taking equity instead of cash?
Yeah, I mean, it is definitely a highly, individualized decision. You'll see it often. I The people that want to do it, the companies that wanna do it are in those early stage or in a capital constrained situation where they're trying to incentivize good talent, but they might not, it might not be looked at if they weren't adding this as an incentive. And then on the other end, you might be willing to do it, if you really believe in the business and you're willing to take a risk, because that you're trading a dollar now for a bigger pot at the end. And so there's risk involved in that, because the pot may be zero at the end. But it takes a specific kind of service provider. But those are kind of the situations where you see it. And then, but eh, in our role, the important thing to look at is if it's something that is attractive to you, either on the company side or as the one that they're trying to incentivize, that you're looking at those details, because how it's structured really makes a difference on whether you should do it or not.
So do you see it commonly used for employees and staff? Do you see it commonly used for these other professionals? Where do you see it show up?
Yeah, in C corps, you see it a lot in ESOPs or restricted stock units. So it is a great way, that even not capital constrained companies are building um, the excitement of the growth of the company, and they're getting their employees involved, and so they are getting the hourly, and so there's not, or the salary, right? So there's not as much of a risk involved there. In, let's say, a early stage technology company, in these, kind of situations that they may not have a C corp, it may just be an LLC. They may be offering, we have a client that is, an AI platform creator, and they are getting offered all the time for their startup companies that they service. Um, hey, we'll pay you this much for the project, but we'll give you X percentage of our company that's going to be, huge in however many years. And so, they're trying to, potentially, pay a little bit less to get, this great, client of ours to build their platform. So,
And in that situation, it reminds me, you just made a comment that sometimes these things go to zero, the equity side of it, right? So
yeah,
that's an obvious downside that I think gets
yep,
missed. And that means that your time, effort, and energy are gone. in exchange for this thing that might be zero in the future, which is an entire possibility. But what are some two or three really important things to negotiate or consider if you do decide that, hey, you know what, this makes sense for me in this situation?
Yes. So the big thing is control. The biggest thing I would say is control and voting rights. Will major decisions be made without you that would affect the value of your interest? And depending on how much risk you're taking on, this matters a lot. And with that, dilution protection. What happens when more equity is issued later, when they're making the promise to the next person? Do you maintain your percentage, or is it possible that even if the company does well, they've diluted you to such a small percentage that you lose out that way? And then the dragon tag rights. If they're selling, do you get to sell with them as a minority owner? And yeah, so I would say kind of top three are those three.
Got it. And so on that dragon tag, so speaking about if there's a liquidity event for the majority group, does that also apply to the minority, is what you're saying, right?
Yes,
So
yes.
there might have been an event, everybody's doing high fives and having fun, but the minority ones who were dragged along, they might not see cash yet,
Yes. Yeah.
and that's that fine print.
Yes, exactly.
Okay. No, this is great. So there's actually a lot of downsides that you really need to get into besides the fact of I just might not get paid and I'm willing to take that risk.
Yep. Yeah. And
Yep.
so unless things are aligned up front, equity really can create more friction than value at the end of the day.
So this is a lot bigger than just upside. There's obligations, there's risks, there's control
Yeah.
to your point, voting rights, dragon tag, and so on and so forth.
Yeah.
And that kind of brings me into particularly the dragon tag. I love that word. It brings me into this whole space of non-competes and the post-sale realities, what I call giving up your personal identity and buying a state of confusion. I mean, look, I hate to say it, but I've got a lot of clients who believe and who've gone through and tested this out, where they actually have an exit, and they go and they fish all day or they golf all day. But I say they're confused golfers and lost fishermen, because their identity's gone with the business, right?
Yeah.
And so I think a couple things to think about is, one, what should entrepreneurs do and what should they be thinking about before a sale to optimize their next chapter, their graduation?
Yeah. No, this is a super important point, and I'm glad you're bringing it up because we've talked a little bit about the preparation to get there, and a lot of times entrepreneurs are just thinking about that as the end date. But you are right, retirement and entrepreneur doesn't really go in the same sentence. And so they may think at the moment that they want to retire, um, but but over and over again we see that there's another thing coming once the dust settles. So it's super important to think about that non-compete. I have seen it so many times where a seller has been like, I don't care, just give the buyer whatever they want. I have no interest in ever running anything like this ever again. And but it's super important that the non-compete and the restrictive covenants are narrowly tailored to what the buyer is buying. It needs to be fair. They're buying an asset, they're buying a business, but you want it to be narrowly tailored. That gives you options when the dust settles, when time passes, the boredom sets in, that they can go, okay, I can't do this for 5 years, but I can do this spin-off because my non-compete only protects this piece. Another thing we've seen is going into angel investing. You have this nice this the money that's come in from the sale, and who you are, the experience, the tactics, the relationships that you've had can transfer into a completely different industry. And so whether it's angel investing or some other way of getting into a different industry and applying all of those things that they loved about building their business in the first place can be applied elsewhere.
So you can have a non-compete that's, at least I've seen it interpreted this way, but can you have a non-compete that's still legit, that's broad-based, and then a owner might be like, "Yup, I can't do anything for 18 months." And then you're like,
Yeah.
"What do you mean you can't? We live in the freest land on earth. You can do a lot of things. What
Yes.
specifically can't you do?"
Yes. Yeah, so for example, worked with a client that was in plumbing, and they were specifically in an industry, And so they took what they learned in that industry, and their non-compete was narrowly tailored, and they couldn't serve any of their clients. They couldn't perform
Oh,
any of the same work. But the plumbing that they did for those clients in that same industry, then they used to then think about, okay, let's build something that's related and we know how to do, but it's not in any way going to compete with what we just sold.
got it. So there could be those lateral moves, or
Yes.
those vertical moves. You might be that plumber or that dentist, and all of a sudden become the wholesaler or supplier to other businesses, right? If that
Yes.
wasn't your
Yeah.
former business, but you have that purview, something that you
Yes.
could do, right?
Yeah. Yeah. And I would add another thing that's really important to think about in the post-sale world is post-sale integration. Um, Again, a seller may not want to have anything to do with the company once they sign, but a good post-integration offer is a great way to de-risk the deal for the buyer and can result in higher earnouts, higher bottom line, and be more attractive to a lot of buyers out there that you're not just gonna fly by night as soon as the dotted line has been signed.
Right. So once the check is cashed, there's still some sort of responsibility to see the success
Yes.
through, right?
We're not getting to a point as a seller that you don't want to see the business another single day is going to be the right time to sell before you get to that point so that you can legitimately stick around and make the transition profitable. And who knows, the buyer may stick around for the next company that the seller builds up and wants to buy it because it was such a great experience.
Well, I mean, this brings it full circle back to the value in our private equity discussion of the, even if you're not going to sell it right now, prepare and build it to sell it because it drives up value along the way. And you just said, if you have an earnout clause or any sort of post-sale considerations, the better the business, the more likely the business is being sold as a business, not just as another job for a buyer.
Oh,
It's worth more for everybody.
yes.
And that's less work for you to do after you cash that check. So I would
For
call
sure.
this a lifestyle decision contract rather than just a contract of okay, I'm selling my business to Emily. Good luck. Oh, you got to have me back for a month every 6 months or a year or whatever. What are we
Yes.
doing here again? Don't you know how
Yes.
to do this?
Yeah. Yeah. No, all the time.
And so, is there any kind of trigger point or something that's emotionally misjudged in this portion? Why doesn't it happen? Why isn't it just a standard operating procedure? This is the first thing you got to do every time.
As far as the post integration or
The thinking through, like it clicks. It clicks when we position it this way. This is why we should do it.
yes. What can we do to trigger it earlier is what you're asking. Yeah, and trigger, yeah. I mean, I just think it takes having someone that's been through it before, a mentor, an advisor, someone that can help you navigate. Again, back to your point on when companies start having offers thrown at their feet, they think, well, I have what it takes to sell. But because there is this, and I like how you use it's a lifestyle. This is a big life process, and as most big life processes, if you just decide on a dime to do it, you're not going to be as prepared. You're going to have a lot of surprises, and finding a mentor, advisors, people that can help guide you through the process and think about things ahead of time, it's going to be just a night and day difference on the experience that you have in selling.
Well, I would say that you're the trigger actually. If we can use that person to listen to our show and consider these items in Rogue Wealth,
Yeah.
you're going to walk through that, and that's what visibility does.
Yeah.
That's your goal, to pulling out that clarity and then using it as leverage for value. You mentioned earlier, even there's times where owner operators are ready to sell. They go through the process and they're like, wait, why would I sell this thing? It runs without me.
Yeah.
It's mailbox money
Well,
that I can keep on the balance sheet. That's separate of all the other stuff that I have going on. I've got a great life with tax benefits and so on and so
yes.
forth. So
Yep.
I
I
think
show up and do exactly what I want. Why would I sell? Yeah.
right. Yeah, no, I love it. And that's extremely, that's the core of what Rogue Wealth is. It's to break the narrative of the mainstream, to get out of the arms of everybody who's just basically gunning for a deal because they get paid on it. And that's what's important about the multidisciplinary view. So, Emily,
Yes.
how can people find you and Visibility?
Yes, great question. Um, visibilitycpa.com. There is a book a call button on the top corner where you can schedule directly with someone from our team. There's ways to email or reach out that way, but we love having conversations. Every business owner is different and every situation is different. And it's super important to us that we understand, each potential business's specific situation and goals, and then make sure you're connected with the right people on our team to help you move forward.
Awesome. Well, we're going to make sure that we link Visibility in the show notes. We'll also bring that calendar link into the show notes as well for convenience. Look,
Awesome.
if today's conversation made any of you realize that you're late to something important and that you need to do something, that's a great thing. That's the whole purpose. It means that you're early enough to address these issues and fix them with control and patience. And so Emily and her team are live in those details, and they go in those rooms that you might only go to once. They live in them. So I definitely suggest a conversation with Emily and the team. And as always, if you want a financial bodyguard in your corner for your wealth, your family, your business, and those complex decisions, that's what Rogue Wealth is for. Thank you so much. Appreciate you coming on, Emily. And thank you to the folks who were listening in. Yeah, it was a lot of fun. Thank you.